You ever see a massive company announce they're spending billions on a new factory or some new gadget that won't even be out for years, and you just wonder how on earth do they make that call? Well, you can bet it's not a gut feeling. It's a science, a really calculated one. And today, we're going to pull back the curtain and show you how it's done. All right, so let's get right into it. At the end of the day, for any big business, it all boils down to one constant critical question. Where do we put our money so it grows the most down the line? And that right there is the $1 million or, $1 billion puzzle. We're talking about a super high stakes decision that can literally make or break a company. You get it right, you could become the next big thing. But if you get it wrong, well, the fallout can be massive. So, how do they actually figure it out? And just to be clear, we are not talking about small change here. These are massive, long-term commitments. Think about launching a brand new electric car, or building a gigantic data center, or even buying out a whole other company. These are the kinds of huge bets that really do shape our entire economy. And look, the reason the stakes are so incredibly high comes down to one simple fact. Once you've dropped $1 billion on a new factory, there's no undo button. You can't just ask for your money back if you change your mind. That cash is gone. It's committed. And that's exactly why the smartest companies have developed some really powerful tools to make these calls with as much confidence as possible. So, to really understand these tools, we first have to get our heads around a core concept. And it's one of those things that sounds kind of simple on the surface, but its implications are absolutely huge. It's called the time value of money. Okay, just think about it like this. Which would you rather have, £100 right now in your hand or a promise for £100 1 year from now? It's a no-brainer, right? You want it now. And there are a few good reasons for that. One, you could invest that money today and have more than £100 next year. Two, there's always a risk you might not get paid in the future. And three, of course, is inflation. That £100 a year from now is just going to buy you less stuff. So the big question is, how do we actually measure that difference in value over time? Well, we use something called a discount rate. A great way to think of it is like an uninterest rate. Instead of seeing how money grows forward, it's the tool we use to pull future money back to what it's worth today. And it bakes in all that risk and the opportunity cost of not having the cash now. All right, on to our next key principle. When you're looking at a huge project, you're just flooded with numbers and data. The real secret here, the real skill, is knowing what to focus on, and maybe even more importantly, what you need to completely ignore. It's all about finding that clear signal in all the financial noise. And here is the absolute #1 rule of investment appraisal. You only, and I mean only, focus on the cash flows that change as a direct result of making the decision. If a cost is going to be there anyway, or a revenue stream exists with or without this new project, it's irrelevant. It's noise. You have to ignore it. So what counts as a signal? Well, things like the cost of brand new equipment you have to buy for the project, the new sales revenue you'll get, the extra staff you have to hire. Now, what's noise? Stuff you absolutely have to ignore? Oh, things like sunk costs, and we'll get to those, depreciation, and how you finance the project. All irrelevant. Okay, this concept of a sunk cost is really powerful, and honestly, it's something a lot of people get wrong. Let's say your company already spent, 15 grand on market research for a new product. That money is gone. It's spent. Whether you launch the product or scrap the whole idea, you are never getting that 15 grand back. So that cost should have absolutely zero influence on your decision to move forward. It's a tough discipline, but it's essential. Okay, let's take a breath. So we've got our two big ideas, right? First, money in the future is worth less than money today. And second, we only care about the cash flows that are a direct result of our decision. Now it's time to bring it all together with the heavyweight champion of corporate finance tools, net present value. You'll hear it called NPV. Look, in the simplest terms, NPV answers just one single question. After we account for the time value of money, is this project going to create more value than it costs? That's it. It takes all those messy multi-year forecasts and translates them into one single beautiful number that tells you exactly what the project is worth in today's money. And the process to get that number is actually really logical. It's just 4 steps. First, you figure out all the relevant cash flows. Second, you use that discount rate to pull all those future numbers back to what they're worth today. Third, you just add them all up. And fourth, you apply one very, very simple decision rule. Come on, let's see how it works with an example. Okay, here's our example project. So at the very beginning, we call this year zero, which basically means right now. We have to spend some money. We've got a $200,000 cost for equipment and another $10,000 for what's called working capital. That's just the cash you need on hand to get things running. So total cash going out the door today is $210,000. All right, now let's look at the good part, the money coming in. We're forecasting that this project will bring in $95,000 in cash each year for the next 3 years. Plus, at the very end, in year 3, we figure we'll get $30,000 back from selling off the equipment or whatever. So that's a nice $125,000 in that final year. But, and this is the key, we know that future money isn't worth the same as today's money. Okay, this is where the magic happens. Let's just say our discount rate is 10%. Using that number, we can create a discount factor for each year. And just look at the table. See how that factor gets smaller and smaller the further into the future you go? That's it. That is literally how we shrink the value of future cash to bring it back to the present. And here's the big reveal. We just multiply each cash flow by its discount factor. So that $95,000 we expect in year 2, in today's money, it's only worth about $78,000. We do that for every year. Then we just add it all up. Our initial minus 210 plus 86 plus 78 plus 94. And that gives us our final answer, the net present value. Positive $48,000, that one number tells us the entire story. It means that after you account for the initial cost and after you adjust all the future earnings for the time value of money, this project is expected to create an extra $48,000 of value for the company in today's terms. And this brings us to that super simple decision rule I mentioned. It's this. If the NPV is positive, greater than 0, you do the project. It creates value. If the NPV is negative, you walk away. It would destroy value. It really is that clear-cut. Okay, so let's circle all the way back to our question. After crunching all those numbers, is this project actually worth it? Should we give it the green light? And the answer is a resounding, confident yes. That positive $48,000 NPV, that's the signal we were looking for in all that noise. It tells us this project is set to earn more than our required 10% return, which means it creates wealth for the shareholders. The decision is simple. Accept. Now, NPV is definitely king, but it's not the only tool in the toolbox. There's another popular one called the internal rate of return, or IRR. And what IRR does is instead of giving you a dollar amount, it tells you the project's return as a percentage. So for our project, the IRR works out to be about 25%. And since that's way higher than our 10% hurdle rate, it just confirms what NPV told us. This is a good project. But, this whole thing isn't just some abstract concept for giant corporations. The core idea, weighing future gains against today's costs, that applies to all of us, right? I mean, think about going back to school, or buying a house, or making a big career change. It's the same logic. So I'll leave you with a question to chew on. What's the net present value of your next big life decision?